Imagine this. A potential billion-dollar startup founder in Amsterdam closes a laptop at midnight. Outside, everything looks like policy success. The trains are on time, streets are clean, healthcare works, banks are stable, institutions function. If you looked only at surface stability, you would probably call this a solved society. And then, the annoying question shows up. Now, if so much is working, why are the most dominant global technology platforms of the last 2 decades still disproportionately headquartered outside continental Europe? Not exclusively outside Europe, but disproportionately. And that is the part that stings. Look, Apple dominates the smartphone ecosystem. Amazon and Microsoft dominate major cloud infrastructure. NVIDIA dominates advanced artificial intelligence chips. OpenAI became one of the most prominent frontier artificial intelligence labs. And by the way, Europe uses these platforms, buys from them, builds on top of them, depends on them. Still, Europe rarely owns platforms at comparable global scale. Not really at that global layer, somehow. The usual explanation is cultural. Europeans are too cautious, too comfortable, too risk-averse. That story is emotionally satisfying and maybe partly true, but it also feels lazy. Now, there is a narrower mechanism worth tracking. Not tax rates in general, not one ideological villain, a timing problem. Tax timing. Specifically, what happens when startup compensation depends on illiquid upside, but risk can become payable before that upside becomes liquid? That sounds technical. I mean, good. Systems usually break on technical design details long before politics admits it, even if nobody says it out loud. As Howard Marks likes to remind investors, risk is what remains after you think you have controlled everything. So now the question is simple, or simple-ish. Where does that residual risk land? Now, Europe optimized for stability, and that did not happen by accident. After wars, currency shocks, and fragmentation, predictability became a design objective. That objective produced real achievements: strong banking, durable institutions, industrial depth, labor protection, social insurance, infrastructure that works. I mean, that is not trivial. It is state capacity. Look, every system that optimizes one thing gives up something else. Stability-oriented systems tend to compress volatility. Venture ecosystems, by contrast, need volatility because they need repeated failure, aggressive capital reallocation, and occasional nonlinear wins, including messy ones. Okay, one model optimizes predictability, and the other model optimizes optionality. They are not moral opposites. They are different engines. Remember, if you scan Europe's economic base, you can see the stability logic everywhere. Automotive is mature and capital-intensive. Banking is heavily regulated. Agriculture is subsidy-shaped and productivity-optimized. Heavy industry is cyclical and energy-constrained. These sectors preserve wealth exceptionally well. They do not usually multiply wealth at venture speed, at least not consistently. That is not criticism, it is function. In utilities, you want reliability. In payment rails, you want reliability. In physical infrastructure, you absolutely want reliability. But if the policy question is frontier-scale growth, then you still need one domain that can absorb many failures and occasionally produce outliers. Today, that domain is usually venture-backed startups. Not because everything else is irrelevant. Because software, artificial intelligence, and digital platforms can scale globally at low marginal cost once built. Could a different engine emerge over decades? Maybe. Under current structure, startups remain the obvious high-convexity candidate, or, well, the most obvious one we currently have. Now go back to that founder in Amsterdam. Deck open. Metrics clean, product real, team sharp. The conversation with investors is not hostile at all. It is, well, almost polite. Kind of polite, actually. But one question keeps returning in different words. So, where's the ecosystem density around this company? Look, that question is uncomfortable because Europe is not empty. Europe has real champions. ASML, Spotify, Adyen, SAP. So this is not a capability argument. Or, okay, not mainly a capability argument. It is a repetition argument. Now, the United States has produced large venture-backed technology firms repeatedly across cycles. Europe has produced them more selectively. Over time, that difference compounds, and then it starts to look natural even though it was built. Remember, density is not a vanity metric. It changes speed. When you have more founders, you get more operator memory. That creates better second-time founders. Those founders attract better capital. Better capital attracts better talent. Then the loop accelerates itself. Scale is not only about this quarter's revenue. Actually, not only revenue at all. Scale also creates recycled founder capital, deeper venture memory, and institutional confidence for the next risk cycle. Now, if Europe wants strategic capacity in artificial intelligence, semiconductors, and digital infrastructure, startups are not optional decoration. They are capacity. And by the way, that pushes us into the next room, the one where this whole thing gets decided in practice. Okay, the hiring room. Now, Monday morning. A founder sits across from a candidate who has two tabs open. Tab 1 is a large incumbent with higher cash and lower uncertainty. Tab 2 is a startup with lower cash and potentially large upside. Look, that is the market. Kind of clean and brutal at the same time. Public sources like levels.fyi, recruiter disclosures, and industry reporting suggest wide US compensation bands with heavy variation by role and company. Mid-level machine learning engineers can land roughly in the $250,000 to $500,000 total compensation range. Senior and principal engineers can often sit in the $500,000 to $1.5 million range. In rare frontier cases, packages can move into multi-million territory. I mean, those are not medians. They are upper bands, not really medians, obviously. But upper bands still set gravity for nearby tiers. You do not need everyone in the top 1% for the top 1% to reshape what counts as competitive. You just need them to exist. In Acemoglu-style language, this is bargaining power showing up inside compensation architecture. Now, at major US firms and labs, pay often blends base salary, bonus, equity, and retention layers. In Europe, senior artificial intelligence roles are often lower, commonly around 120,000 to 250,000 euros in base salary, with total compensation depending heavily on equity structure and company stage. There are exceptions, of course, but, I mean, the upper tail is thinner, if we're being honest. So startups usually cannot win a pure cash war. Their real counteroffer is the equity bargain, and they know it. Take less cash now, share more upside later. If that upside channel weakens, startup compensation does not become slightly less attractive. It becomes structurally less competitive. That is not a moral argument. It is benchmark anchoring in a global labor market. Now, what is this bargain exactly when you strip away the slogans? You join early, you receive options, they vest over time, you exercise at strike price, you hold through uncertainty. If execution works and liquidity arrives through acquisition, a secondary market, or an initial public offering, gains are realized and taxed. The model is already risky. Startup outcomes are uneven by design. A small share of companies creates outsized outcomes, and compensation architecture has to survive that distribution, not avoid it. If taxation shows up when liquidity shows up, risk is harsh but coherent. If meaningful liability can show up before liquidity shows up, coherence weakens. Maybe slowly, but it weakens. Kind of quietly at first. That sounds like a technical distinction, In an offer negotiation, it is not technical at all. It feels personal very quickly. Remember, this mechanism is what lets startups compete with cash-rich incumbents. If it weakens, engineers drift toward big firms. Founders compensate with more cash, burn rises, and venture return profiles compress. So in this context, equity is not a loophole. It is financing infrastructure for early-stage competition. Basically, the core rail. And now we have to look at one concrete policy design where timing matters. Now move from hiring rooms to tax architecture. In the Netherlands, taxation is organized into boxes. Box 3 applies to wealth, meaning assets held by individuals. Historically, Box 3 taxed a deemed return on net wealth rather than only realized capital gains. After court rulings in 2021 and 2022, reforms moved toward differentiated assumed returns by asset class, including savings, investments such as shares, and other assets. The structural point is straightforward, even if the legal details are not. Box 3 applies annually to net wealth above thresholds. It is not solely triggered by realized liquidity. Public shares are typically valued at market price on a reference date. Private shares may be valued using assessed fair market value, often informed by financing rounds. So taxation can apply within a wealth framework based on assessed value or deemed return, even when a holder has not had a liquidity event. That is the friction point. Value can move before cash appears. And yes, policy models often assume valuation timing and liquidity timing line up nicely. In real systems, they often do not, and people in startups know that. So the claim here is narrow and mechanical. When valuation timing and liquidity timing diverge, downside timing risk can increase for startup participants. This is not tax advice. It is incentive geometry. Now, let us run one stylized scenario carefully. An employee exercises startup options, 100,000 shares at €1. Exercise cost is 100,000 euros. 2 years later, a funding round implies 50 euros per share. On paper, the holding is worth 5 million euros. Assume this enters a wealth-based taxable base with a deemed return of 6% and a tax rate on that deemed return of roughly 30%. Taxable income is 300,000 euros. Tax due is about 90,000 euros for the year. In cash. Not on paper, in cash. Now, pause on timing. The shares may still be illiquid. No initial public offering, no guaranteed secondary market, no buyer when the tax bill arrives. So paper value exists, but matching liquidity may not. That is the mismatch. Tiny on paper, painful in real life. And yes, this is illustrative, not predictive for every case. Exact outcomes vary by structure. But the mechanism itself is clear enough to alter behavior, even before any big headline appears. Now come back to human decisions. Same candidate, same 2 tabs. Offer A is higher salary with more predictable tax timing and lower volatility. Offer B is lower salary with uncertain upside and potential annual wealth-based exposure before liquidity. Even if extreme outcomes are rare, perceived downside timing risk still shifts choices. Remember, ecosystems usually do not move through dramatic headlines. They move through marginal reallocations, small moves that add up. One engineer chooses the incumbent. One founder incorporates elsewhere. One employee delays option exercise. One investor discounts startup equity more aggressively in compensation negotiations. None of these moves looks historic on its own, but repeated over years, they become drift. Most structural shifts start exactly this way, not with collapse, with ordinary decisions repeated at scale. Now, widen the lens one step. If fewer top engineers choose startups, founders need more cash compensation. Burn rises. Dilution rises. Expected upside for founders and employees compresses. Recruiting leverage weakens further. Investors respond by tightening risk appetite. Then, scaling gets harder. Then, cross-border arbitrage starts to look less like strategy and more like necessity. This is usually not a collapse story. Not really. It is an adjustment story, and adjustment can be brutal if it compounds. And in compounding systems, small shifts in incentive geometry can produce large, long-horizon outcomes. Who benefits under that pressure? Usually already scaled platforms and deep capital pools. Who absorbs downside? Usually early-stage actors with thinner balance sheets and less policy insulation. That is not conspiracy framing. It is a recurring pressure pattern in asymmetric systems. Now, we should challenge the thesis directly. There are serious counterarguments. Many individuals sit below relevant wealth thresholds. Employee option treatment can fall into different tax categories depending on structure. Private valuations are not always marked aggressively. Liquidity events are uncommon. Europe's startup density gap has multiple causes beyond tax timing, including capital market depth, regulatory fragmentation, and institutional risk appetite. All of that is valid, so this is not single-cause determinism. It is a marginal effect argument, nothing more mystical than that. Keynes and Hayek disagreed on almost everything, but both would recognize one thing here. Rules can alter behavior before aggregate statistics make the shift obvious. So the useful question remains narrow. Does annual wealth-based taxation on illiquid assets increase downside timing risk enough to influence marginal talent and founder behavior? Because ecosystems are built at the margin, and they are weakened at the margin too. Okay, so where does that leave us? Europe did not ban startups, and it did not outlaw equity. What changed is the measurement logic around wealth and the timing logic around taxation. One model is mostly anchored to realized liquidity, while another can apply annual taxation based on assessed value or deemed return inside a wealth framework. If startup compensation depends on illiquid upside and tax timing partially detaches from liquidity timing, the risk geometry changes. When that geometry changes, behavior follows. Contract design changes. Option exercise behavior changes. Hiring strategy changes. Venture portfolio construction changes. If this effect exists, it likely appears gradually. Fewer high-risk joins, more cautious option exercise, more geographic flexibility at the margin. Not collapse, but adjustment. And then compounding. Quietly at first. Compounding is less patient than policy debate. Growth ecosystems rarely fail loudly. They usually drift, and over long horizons, drift becomes decisive. That is one way to read these incentives. Not the only way. But it is a pattern worth watching closely. Very closely.